From one retail investor to another. This is Trader72. Welcome back to my YouTube channel, guys. I hope you are all well on this fine end of week. We are getting there. It's coming up to the weekend, and I'm sure we all deserve a nice rest after this week. Not a massively eventful week, but it has been a busy weekend for different reasons for me in different areas of just the trading. But we are back with another analysis, and actually it's not an analysis this time around. It's actually, as you can see from the title, you can see it's my top 5 companies that I think are currently bargains. Yes. Oh, yes, indeed. These aren't speculative play. These are top-end high caps in the US market at the moment. We're going to dive in because they're quality businesses that I've chosen specifically for that reason, and they are at currently a discounted price off its intrinsic price. You guys know that I love my intrinsic price. I love my DCF model. It gives you a true idea of the company itself and its price and where it's at, not what Mr. Market gives you. So if you discount this right and you do the model right and discount it right, you should get a proper price to buy it at. You would not buy a house inflated if you can. You want to buy the house, the brick and mortar, at the right price. So this is what we're doing for stocks on this one. So I'm going to keep it simple, straight to the point, a few pros and cons on each company, and then a DCF model to show you guys where we're looking at. Most of these companies we're looking at here are at value of 25 to 30% discount, so it's quite a major discount, so less to fall if it falls further down. So that's what we'll go through to start off with. We'll finish off with a little bit of a news on what the market is. The market is at an all-time high. The Nasdaq is moving up and up. This is thanks mainly to the AI play, the Nvidias and the chip makers, the AI chip makers, who are literally zooming like a rocket. Now, are we due a crash? Are we due a fallback? This is what you guys have got to be very, very careful, including me as a small retail investor when buying stocks. Also, just to finish off, I bought a new stock, one British stock actually, which is most of you maybe from stateside or maybe from internationally that listen to my show, watch my show, not listen, sorry. I'm not a radio station. I'm a bit old-fashioned, showing my age there. Where obviously it's a grocery shop called Marks and Spencer's, but I'll come into that in a minute. So guys, Meta, we're going to start as that first company. Yes, some of you might just think Meta, are they not overpriced by like the top 5, 7 or like Google and so forth? But no, these guys are at a discount right now. But we'll come to that in a second in terms of the DCF model where we're at with the intrinsic price and the MOS. But let's just go through very quickly. So Meta recently just announced their latest set of results, as you can see here, for Q1. Results came in very good, 33% year-on-year up on income, net income as well at 36%. They've also raised capex, which is a bit of a problem, I think, at the moment, with a guidance of 125 to 145 billion, and also borrowing further to actually extend their expenditure with bond purchases, which means IOUs with investors as well recently. But it has also obviously surpassed 300 million users. But there are some issues in the background which may have affected the share price in terms of users flatlining at a certain price, as a certain amount numbers. But let's go through quickly the bulling cases. Explosive revenue growth. Obviously, that is not in doubt. The numbers stack for themselves. We've done an analysis. Guys, go back to one of my videos on the Meta analysis. Very strong fundamentals. We don't have to go back through all this again. There is, as you can see, even from their latest results there in terms of revenue and net income and also free cash flow. Very strong on free cash flow, although that is dwindling through their expenditure, which I think is one of the main problems with the Mag 7 at the moment. Operating leverage. So, Meta maintaining an operation margin of 41%. Monetization of next-gen services, ad pricing 12%, impression jumped 19%. That's obviously using AI for advertising. And Llama for anticipation. Llama is expected to later this year. Bulls believe Meta will consolidate its position as the open source standard for AI. Now, against this background with Meta, Astronomical capex. I think this is going to be the big issue. Will this pay off? Will the monetization pay off on the amount of money they're spending on power and data centers for Meta? That is something that is obviously a big question mark for a lot of investors, including the big investors in the market. So that is something. Obviously, there was the metaverse, which they dumped and wrote off, at a tremendous cost as well. And there is issues coming up with the amount of users that are now kind of stabilizing but flatlining and potentially something actually dropping slightly. So that's something you guys may want to look at as well. There's a few EU antitrust hammer that's constantly happening. EU constantly after the big seven to cash in at some stage. I mean, that's my opinion, obviously. There's a core peak there. Some metrics suggest that family apps may be peaking in core markets with internet disruption in certain regions, rising agentic AI competition, which could also be happening. Meta's social moat looks slightly more vulnerable. I mean, that's a bear case. Obviously, there's a case for every side of it, but still, monthly active users is at nearly 4 billion, daily actives 3.4. Operate margin is still at 41%. Free cash flow is still around the $15.5 billion, which still not too shabby, as they say. And revenue is up, net income is up, but capex is up. So that's where the state of play with Meta at the moment, guys. A little bit of yin and yang there. It's something to look for. Now, I will say I am not a financial advisor, so please do your own due diligence on this before you either buy or not buy. I buy, obviously, in any of the stocks I'm mentioning. I'm just here purely on an advisory situation and just using my own experience, but I have no financial background, guys, so be aware of this and please be careful before buying in. Make sure that you absolutely understand the business and that you're happy with the business you're investing in at the right price. This is the whole point of this specific YouTube upload. So there you go, guys. In terms of the discounted cash flow, I brought this up there for you guys on screen. Again, this is all very much speculative in terms of what the growth and what people expect the growth to be on this DCF model. As you can tell, this is 10 years back and 10 years forward. We have a growth rate that we kind of work out in terms of from the last 10 and 5 years. And also working out, obviously, at a discount fee of mostly 8% with a terminal fee of terminal, which is beyond the 10 years at 3%, which is pretty much average on GDP or US GDP. So if we put in at 12%, which I think is fairly conservative, you could go up as far as 16% if you wish so, based on the 10-year CAGR. But I think if we're looking back at 12%, now the 12-year at the moment, I think is probably reasonable in terms of growth because the company is now kind of reaching a maturity. So if you calculate this pretty much through the actual 8% discount, we have an overall intrinsic price of $825. Now, remember, guys, this is the actual true worth of what we think Meta is based on its growth. Now, reverse DCF is at 6%, although I think that could be slightly higher. So that shows you that the stock is still cheaper because obviously that's what the markets are factoring in terms of growth. So you can see that there's less growth there, another 6% to go between the growth rate we came up with. Even more if you decide to go at 16%. That's up to you to decide whether that is potentially right. Now, that does give us a fairly hefty margin of safety around 32%. Yes, guys, 32% discounted MOS. So that's a safety margin on the stock. Now, remember, guys, this has to marry up with, the stock, the story of the stock, what it's up to, what it's doing with the intrinsic price. Don't just go in because the intrinsic price is at 32%. You need to make sure the story matches the share price, the current share price or the intrinsic price, share price. So that's my biggest advice at this stage. So 32% is, I would say, for someone like Meta, pretty good. It still, I think, has quite a way to go. I think it's certainly going to consolidate maybe slightly more, and like any other company, there are always issues ahead in terms of competition. I still think that Meta has a very strong moat. It has clearly a meaning. It's got, obviously, Zuckerberg as a manager. Yes, he has, like any manager, had his up and down. And the numbers, the fundamentals also match up. So I think from the 4 M's, which is what I apply my system to in terms of research. It's pretty much up there, return on investment as well. So anyway, as you can see there, Goldman Sachs, JP Morgan, all overweight and buy. Target around 800, 760, maybe slightly less than what I am at looking at the moment, but still very bullish in terms of the markets and the Wall Street watch list. So one of my favorites here, and I would say my favorite as a company, because I actually like the company in Uber. I don't actually own currently Uber. I did a few times. I've bought in and out of Uber a few times in the past year. The share price has stagnating between in the mid 70s for the past year or so. Bill Ackman is a big fan of it, obviously one of the big investors. Actually, guys, look out for the F13s coming out, which obviously is 45-day delay on what the big investors have bought into. But I'm pretty sure that big Mr. Ackman has kept his strong foothold in Uber. And I don't disagree with him. I think Uber is a terrific company, turned obviously from a negative free cash flow to a positive free cash flow, and it is become a global company. So let's have a quick look. The last set of results, as we can see here, beat expectations by 14%. Actually, a really good set of numbers for revenue. Net income came in at 1.8 billion. Free cash flow came at 2.3 billion. Uber announced plan to deploy 50,000 robo-taxis, which obviously is the next big thing at the moment in terms of competition with Waymo, Google, etc., etc. It will have 50,000 globally by 2031. Obviously, they're not going to make the cars. We all know that Lucid is making the cars. They're just putting the software in, which I think is very clever, and bringing all of their pickups or their clients with them, or clients being obviously pickups. So that we'll see that how that pans out. Also, membership for Uber One as basically surpasses 50 million. So all in all, really good set of numbers, which I think did spark the share price back up to $77, $78 a share. Now, dominant ecosystem, bull case, operating leverage, obviously very good in terms of grew by a good rate, 2.3 billion in free cash flow. As of April, it surpassed 50 million. We just explained that. Advertising growth is also scaling up. And obviously, AV as a partner, not a threat. Unlike Tesla, which owns the whole stack, Uber is positioning itself as an indispensable marketplace for autonomous vehicles. So we'll see how that pans out. Now, on the bear case, obviously, zero-sum game. Obviously, there's going to be massive competition with Tesla for the robo-taxi market. Who will come out of that best? Well, that is obviously up for debate. That's definitely worth taking a look at that in terms of slightly more detail. There's obviously constant ongoing regulatory worker liability with Uber in terms of classification. Dark cloud, new legislation pushed again by Europe and certain US states. I'm quite bullish on it, I have to be honest with you. It's got tremendous free cash flow. Again, the fundamentals are amazing, especially in the last 4 or 5 years. A real turnaround play, Uber. There's no doubt about it. It's got 50 million plus users. And like you said, like you can see, it's going from strength to strength. I think the big issue for me will be what will happen with the robo-taxi market. Are they going to put more and more money on their capex into that business? But in the long run, unlike some of the bigger boys like Meta or Google, they're not spending all of their money or capex money into robo-taxis. It's actually spending money in a specific software that will be installed in the actual vehicle itself, which will be done by partners. So they're partnering with other companies to do this. And I think that's a very clever way of looking at things. I think that Uber personally will go from strength to strength. But the question is Uber currently at a DCF model cheap? Let's have a quick look. Discounted cash flow for Uber, as mentioned, growth rate at 12%. Again, it has been obviously for the last 3 years, 120. It was never going to sustain that. So we do need to kind of get a level off there of what we may think. Now, you guys may have a completely different outlook on the growth rate. Your growth rate will dictate where the intrinsic price obviously goes to, and it's obviously speculative. For me, 12% is, again, mid-ground. I think it's not too conservative, but not too aggressive. And I don't think you should ever be too aggressive with with obviously a DCF model, from my point of view anyway. You guys may well disagree. Please do make comments below if you do. Now, for me, the intrinsic price is around $126. It's never gone anywhere near that so far. It has gone north of 100 at some stage or another, especially on the back end of Bill Ackman investing heavily in the last few years. Now, the margin of safety here, guys, is still at 31% for Uber, which is, I think, a tremendous. Now, it was almost at about 40 to 50% a few months back when it was lingering around the $69, $70 a share. It has since then gone to 74, so obviously that's the reverse. Well, the reverse DCF is 6%, so again, plenty of leeway there. The obviously analysts are still very much buy and overweight on although they've taken it back a tad, but still a target between 115 and 130, which actually is spot on in terms of my intrinsic price. That's why it goes into my list of my top 5 bargain caps or US caps at the moment. I think it's got tremendous potential for the future, especially with the robo-taxis, the expansion of potentially, dare I say, no drivers to deal with in terms of business could actually increase the bottom line. Not that I'm saying that I'm advocating for people losing their jobs, obviously, but in terms of as an investor for Uber, that is something they're definitely looking at. So I think that Uber personally will go from strength to strength. It has got issues against maybe his moats. There is quite a competitive market still. I still think it is still one of the biggest pickups in terms of cabs, but they've got other businesses. They've got a freight business. Delivery service is going from strength to strength. So again, not relying on one singular play here. We are looking. Next on the list, ServiceNow, the third in our top 5. We know about ServiceNow. I did recently a full analysis. Please do check my playlist if you do want to know a bit more. Again, the numbers were phenomenal. The business is phenomenal. I'm not going to go into too much of that. I think I'm just going to go, as I said, straight into bull case, bear case, and the latest news. Give you an idea of the pros and cons and its DCF model, what the share price will be. If you want a deeper analysis, do request it. It's on my playlist, or for any of the other companies, I can delve back in and do a further analysis at this stage. So, ServiceNow. Obviously, recently bashed again by the SaaS apocalypse recently. I think it's at a tremendous discount. It's a tremendous business, has major clients, very much within the fabric of the US financial industry, and has a strong foothold with some major players. Also, their numbers haven't been affected as yet. So again, proving that ServiceNow is potentially at a bargain basement price based on their business and how good the moat management and the meaning of the company is at this moment. Latest news was ServiceNow unveiled a new action fabric, a new AI specialist automated work across HR and IT. Again, shows you that they are integrating AI at a very fast rate and obviously monetizing that as quickly as they can, which means that they won't be losing out to the AI revolution as yet, as many people within the market are thinking it might. Raised AI revenue guidance expected at 1.5 billion, which is fantastic number again, up 600 million from 25. Completed the 7.7 billion acquisition of Armis cybersecurity, again expanding in the Internet of Thing LOT and connected ecosystems, etc. etc. Platform milestone has 50 million plus users at 98% renewal rate. So again, subscription based, which obviously is always a good. So successful pivot to agentic AI, which I think a lot of people feel those companies are not. Now assist explosion. Management raised its AI specific guidance. Massive scale and ecosystem. 50 million platform users. 98% renewal. As I said, also the latest acquisition of Armis. Accenture partnership, which is a new partnership for deploying engineer program with Accenture to help companies scale AI agents and close to the delivery gap. So it's a market leader in automation, strong AI vision ecosystem, and has a very strong investment thesis. On the bear side, efficiency paradox. ServiceNow has a core business around changing per seat. Obviously, that's the same issue that another one we will be mentioning to in a minute has the same issue. It's all about the seats and the human versus the AI agent. Yes, that could have an effect, but again, as I said, do I see ServiceNow 10 years down the line being around? Yes, absolutely. And I think that's a very important question that any investor should ask themselves. Yes, it has competition from the big three, Microsoft, Salesforce, Oracle, but they've all got their own issues themselves trying to survive at this moment. So I think, it is the survival of the fittest. Again, 50 million platform users, 98% renewal. That's something to bear in mind. Revenue up, free cash flow up. Again, fundamentally, not a problem. A good product, good management, and I think ServiceNow will definitely be around. And they are the bargain. Let's have a quick look now at their DCF model. Again, the intrinsic price, we're looking at $146 a share, which I think is very reasonable considering that it's lingering between $90 a share at the moment. So very much an up there and definitely an upside to the stock as it stands. Now, I went for 10% growth rate. Apologies for the graphics. I had to change it last minute, so I had to pick this one up quickly. This is the YouTube. This is me being real and obviously realistic in terms of sometimes when you have to put these shows together. So apologies in terms of the graphics. I had to change that one up. I had an issue with the other one. But anyway, moving forward, growth rate 10%. I think that's a very low, reasonable number. DCF, reverse DCF at 2.50, so that's where the markets are factoring in. So there's definitely a cheap gap there between 250 and a growth of 10%. You could potentially go up to 15% considering that 5-year CAGR was at 26, 10-year 64, but I think the company's now maturing and again to a certain level. So I think 10% is very possibly a bit conservative, but it is a competitive market there. I think it probably could go up to 12% at potentially. But at the moment, as it stands, it gives us $146 a share. That gives us nearly 40% discount on the share price. So again, very much belongs to, like the other two that I've showed you so far, in that bargain basement for the share price itself, guys. So definitely it takes its seat amongst them for me. So fourth on our list, guys, Intuit. I feel Intuit obviously belongs in that list at the moment. Again, very much part of the SaaS apocalypse at the moment. And obviously it has TurboTax and QuickBook, which is used globally by most accountants and individuals. Again, under threat from AI agents, Anthropic, that it can do its own. Eventually we'll be able to do very quickly your taxes in terms of companies or individual. And there's obviously the threat there. But at this moment, again, in terms of numbers, I'm not seeing it. The fundamentals are, again, very much so. I did actually, again, analysis on Intuit and Salesforce versus Salesforce last week. So do please check that in terms of deeper analysis. But Intuit's reported numbers, revenue was up 13% year on year. Net income was up as well, and free cash flow at 1.1 billion. Credit Karma revenue grew for the first time in 23% year on year in Q2. RIS direct files programming officially shuttered, which obviously was part of obviously competition to TurboTax, has been shut down by the government, which restored the moat for that side of the business, which is great news, and also announced a buyback. And now obviously we like buybacks, all investors like buybacks, especially when the company buys back at their cheaper price. That's obviously very crucial. I'm wigging my finger there, so apologies if I am, but I am quite strongly about the buybacks. That's always good news for any investor that goes to the bottom with a share price. And obviously makes the share price value more. So I've mentioned all the positives there in terms of the bull case. Now, in terms of bear case, AI commoditization, the bear argument is that if AI can do taxes and bookkeeping, why does we need a $400 years subscription? True point. Very good point. Open source or low-cost AI agents could eventually perform. Now, eventually, possibly, allegedly, maybe even, I think is the right word. At this moment, would I trust AI to do my taxes? Probably not, guys. I would certainly trust more established software such as QuickBook or TurboTax from Intuit for sure. And I'm sure most accountants would probably agree with me. MailChimp was a bit of a disaster, $12 billion acquisition at the time. Potentially has had struggles with integration. Management recently pushed the target for double-digit growth. But we'll see. That could be a bit of an anchor around its neck. Market share saturation. Over 100 million customers bear ask who is left to buy within in terms of buying into the companies. Now, growth is dependent on extracting more money from existing users. Now, that could potentially be a problem. And political fragility. that again is a bit too, that's argues that Intuit will spend millions on every year on lobbying just to keep its business model legal. Again, that's quite far-fetched from my point of view. So yes, there is obviously the issue that AI, like all the other companies, could be threatened. Do I believe Intuit will still be around? Yes, again, I will do like ServiceNow. I think these are businesses that we need. I don't see any chunks of cash falling off the cliff at the moment. The moat's been attacked at this moment in time. So I think, depending on, I think the EPS is up, free cash flow's up, 3.6 billion, which is a fair whack, and a repurchase program of 2 billion. So from as far as I'm concerned, at the moment, Intuit, I'm fairly bashed and I'm fairly beaten up from my point of view. So let's have a quick look now at the DCF model, guys, for Intuit. As you can see, I've given it a reasonable mid growth rate of 8% compared to 18 and 21. Again, these companies, don't bear in mind, just started, or not, well, obviously on an up trajectory growth, so there's always going to be a higher number. As it matures more, obviously you have to pull it back down a little bit. So I think 8% with a 1% reverse DCF, I think that's factored in by the market. Definitely room for growth there on both. Again, the intrinsic price we spat out from that model based on future cash flow, past and future cash flow, is at $598 a share, almost 600 there at the moment. So at the moment, the share price is lingering. I can't actually exactly remember what at, but I know that obviously at the moment it's discounted at 39%, almost 40% discount. I mean, that is an incredible discount again on a company that there's no signs of issues at this moment, and is again a well-established company with great numbers. So for me, again, it's a mystery why it's been like that with the market, but not a mystery. We know why, but I think it's a mystery of why it keeps being bashed when the integration as well. They are all integrating AI within their businesses, so it's not as if they're standing still or lagging behind. So again, a big question mark there to be asked on that side. But again, very much in that ballpark of above 25% discount. So that goes into my fourth company into the top 5. Good old Adobe next on my list here. Adobe, which is one of the companies that I own currently. And it has been a bumpy ride for Adobe. I obviously work in the creative industry myself in post-production for 30 years. So probably the closest to what I know most in terms of business. And as far as I'm concerned, again, very much unfairly punished by this obsession of the AI takeover, and how these companies will apparently disappear out of sight. Hence why I think the market is wrong on this one. Now, that's my opinion, of course. I think that Adobe, I bought Adobe probably too soon as a falling knife, so I've kind of paid the price for where I am at the moment with that stock. But it has reached, I think, pretty much a all-time 52-week low. And again, a great set of numbers in the latest May, raised FY26 revenue outlook to 22 to 23 billion, prior from 2270 to 23. Firefly adoption accelerating, doing very well. Generative AI features now embedded within that, so across the Creative Cloud, Document Cloud, Experience Cloud. Strong Q2 FY result beat, and Adobe expanding enterprise partnership and launches new Firefly models for video, image, and 3D. So not as if, again, they're lagging behind. They're not, oh God, we've been left behind, we need to catch up. Not at all. It's been integrating Firefly for as quickly as AI came, up in terms of revolution. So AI deepening Adobe moat, obviously. Firefly Sensei, driving innovative cross creative cloud, mission critical recurring revenue. Again, huge moat in the creative industry, as well as all the other apps they own. Again, I did quite a few analysis on Adobe, so please check that out in my playlist. Strong financial performance. Again, no dent that I can see in terms of performance. Yes, they are reaching a peak at the moment. That does tend to happen. And yes, there is Canva and Figma that are nibbling at the heels in terms of the moat, but hardly an invasion at this rate. So I think in terms of the bull case, they're very much exciting. Now, Where do we see the issues with Adobe? I think one of the biggest issues for me at this moment, and it is CEO-less. The departure of Shantanu Narayan after 18 years in charge has brought up Adobe where that I think is a big issue. I'm quite surprised they haven't come up with a successor as yet. No succession. I know they have to take their time. They're going to make sure they've got the right person in charge. But the markets will demand, or investors will demand, to have somebody leading the Adobe into a new era. And that still hasn't happened. So that is definitely a concern. SaaS apocalypse, AI commoditization, skill devaluation, all tools may make pro content too easy, seat compression, same issues that we have with ServiceNow and Intuit in terms of the seats, disappearing numbers, affecting the company, and how much AI will potentially take over some of Adobe's strength or skill sets in terms of a business, which is plausible, of course, like it has for any of the others I've mentioned. However, very strong foothold. It would take a lot, I feel, for even Figma or Canva to take over that side of the business, even if they're offering very good packages and deals to be used. But I think realistically at the moment it still has a very strong moat. Revenue still up. The forward guidance was up. 10% growth, revenue up. Free cash flow is still at $6.5 billion. I can't see that. If a free cash flow is at $6.5 billion for 25-26, I can't see why there is such an issue with the company itself. It's a quality business, quality compounder, and I feel that Adobe at the moment are unfairly being punished. Now, of course, I am a shareholder, so I would say that obviously do your own due diligence on this. But for me, it's got 26 million Creative Cloud subscribers, regular income as well, which we like, which obviously Intuit and ServiceNow have a very similar business model. And again, you know, a bullish watch by me for sure. Let's have a quick look now at the DCF model. For me, the discount cash flow for model for Adobe, I'm being very, I'm going to go quite low on this. I still think that potentially 2% growth could be in the ballpark. Let's go for argument's sake, looking at 0% growth for the next year or so, for the next 10 years. I think that with a reverse DCF of 4.9, and that's minus 4.9. So at the moment, really, there's room for growth there. I still think that, you know, 2 to 6% would be probably very reasonable as well in terms of value there. That would increase, obviously, the intrinsic price. So up to you guys to decide what you want to do. But let's go at 0 at the moment. It's still coming in at $378 a share. The share price currently is at $235. So room for growth there. And again, a margin of safety around 34%, guys. That is bloody good. It could actually be even more now because it's retreated back to 235 from the initial price we've got on this. So we're looking at probably exactly 40% discount and more if you guys decide to look at a 2% growth, which I think is not unreasonable at 437. So again, I think it's, you know, quality stock. Moat is wide. Strong free cash flow. I can't see where the problem is with Adobe at this moment in time. Again, question you've got to ask yourself, do you see Adobe around the next 5-10 years? Absolutely, especially in the creative services. As I said, it's not just an editing company, a software company. It has various different, as Acrobat as well, which most people use. And yes, there is a threat of AI. Yes, there is a threat of seats being replaced and software being replaced by smaller companies. But every company has competition. I think it's healthy, but it doesn't mean the business will disappear. And I think what is happening in terms of share price is, well, frankly, unbelievable at the moment. I think that the share price should definitely be further up. Again, I am a shareholder of the company on my portfolio. So, you know, where we go. So that's where we're at with the top 5, guys. That is my top 5 as it stands. My final thoughts, guys, on this top 5 bargain of US stocks, major caps, what should I say? It goes into several departments, obviously several key parts. I think the first thing is capital, as it says there, capital allocation. These firms don't generate cash, they deploy it wisely. They are strategic, there's practically no debt. They do share buyback, obviously because their share price is on the low. It's got a comfortable, most of them have got a fairly comfortable moat, which I think is very important in terms of market placement, where they stand in their own markets, be at least number one, number two player in that market. They have a network effect, brand dominance, a lot of them, recurring revenue through subscription and so forth. Great ecosystem where they have several businesses under one roof. Pricing power and operational scale, so they can scale up, obviously. In terms of the actual final thoughts, these are hugely successful companies that have been punished by the markets for various different reasons, mostly through the SaaS apocalypse that we are well aware of, we've discussed many of times. And I think in certain ways, unfairly punished, because these businesses are integrating their own AI licenses or software within their own business and are not just standing still. So I think that's an important part of you guys, to look at, from Adobe to ServiceNow. They're all going for their own AI integration. And I think that is a key point to all of these businesses. The other businesses, whether or not they'll be around, as I keep saying, they will be around. Most of these companies, I feel will be around. And that's my own opinion, of course, will be around for the next 5, 10, 15 years. And are well entrenched within the market, especially the US world, or the US market, and some globally as well, but mostly US based, where they are, their services are basically you can't do without. They're almost not too big to fail, but they are integrated in such a way that it would be very hard to replace those products or companies. The free cash flow is also very important. Most of these companies I've got are cash rich, which is very, very important. That means they can pay off their debts, or they can spend on capex, or paying off, obviously, shareholders in terms of, dividends. So that is also important. Some of these companies obviously leverage slightly, but most are cash rich, which is, as I said, the lifeblood of any company. Most importantly, though, apart from the fact that they're all good quality company with good fundamentals, they all have a margin of safety. And I know I keep harping on and repeating myself, but the margin of safety for these five, which are the particular criteria, was they were well above 25% MOS from its intrinsic price, are all, although it says 25 there, really most of them are 30% and above. So the margin of safety is all important. So just to say, when discussing that discount, you might want to visualize the relation between the intrinsic price and the market price. And there's a complete disparity, which is what Mr. Market, as in Rule 1 book that I keep mentioning, mentions Mr. Market, gives you a price. And on the other hand, what really is the intrinsic, the true worth of this stock. So, if you are going to invest in those companies, there is a buffer of safety if there is a crash or a fallout or something goes wrong. Now, nothing is for sure, nothing is for safe. It may well fall further, but at least you have a chance to recoup faster than others if they've bought at a higher price. Remember, guys, a good story and a good share price goes well together. This is how it is. So I think in terms of all of those criterias, they are completely and utterly covered, in my honest opinion. Those five are. Now, there's a few others I would have mentioned in this, MasterCard and Visa as well, which are two massive compounders, huge, rails in terms of their own market, merchants, and they dominate their market. There has been a bit of a nimble about it. There's been a bit of a fight with the Europeans wanting to have their own credit cards. The US government wants to cap the interest rate. But I believe that these companies will still be around in probably further than any other company. They're far too entrenched in the global world we live in. There is not a single machine that's not used by the MasterCard or Visa. Now, reason why Visa isn't in there is Visa and both MasterCard are just in between that intrinsic price around 20 to 25%. So they didn't quite qualify for my criteria, although I would have probably put MasterCard in there as it is around the 25, 26 mark. But I decided to go for the top five, so that's where it's going to be. So there we are, guys. That is my honest point. Durable, high quality management as well. They've got the 4 M's and they cover pretty much my whole criteria. Strong free cash flow, durable competitive advantages, high quality management, although one of them is without one at the moment, but I'm sure they will sort that out. Intelligent capital allocation, which is important to know where you're going to relocate your money to expand the business, long-term compounding potentially, and significant margin of safety. So I think that that bottom four there is definitely the biggest criteria for me in terms of these companies. So the markets, because it is coming to an end, and as you will see at the moment, I have invested in Marks and Spencers, which I think some of you may know or not know is one of the biggest grocery shopping in UK. It was in America for quite a while. I'm not sure if there's quite a few left. Very good quality grocer, competes with, obviously Tesco's here and Walmart probably in America, they kind of respect, but it's a much more niche market. And I bought it at a 52-week low and very happy to have done so. I'm actually up slightly at the moment. I bought 314. And the other one I bought today, this week, is S&P Global. Yes, guys, I'm back in with S&P Global, another quality compounder, unfairly punished by this whole SaaS situation, and it is a credit rating. It runs the S&P, and I love that company. I think at the moment it's getting quite bashed up. I bought it at 408. It's currently 406. So sitting on that for a little while and see where that goes. It's in the red. I think there's a lot of profit taking on the microchip companies and so forth, which have absolutely moved strategically so high up this week. The Nasdaq is at an all-time high, and it has literally, I think, having a little bit of profit taking. Also, the uncertainty of crude oil, currently at $111.5 a barrel on crude. You guys, I've got a position short on that at 92 and 100, so I am slightly on the wrong side of that at the moment. Still hoping that eventually they will sort this out, because it can't go on. It will eventually put the world into a global recession. I'm not kidding, guys. That is a truth. So I think it's a time to see if Trump and Iran and the Chinese can possibly do something, although are looking unlikely at the moment. So there you go, guys. That is my latest analysis on the 5 bargains. I hope you enjoyed. Please subscribe and like, because a lot of you guys click but don't subscribe. I would really appreciate if you subscribe. That always helps. And like, obviously, or not like, please comment below if you agree with my choice, and if there's anything else you guys want me to add or analyze as well, because any input would be great. So let me know any company that you guys would like me to look into, and I would be glad to oblige. So there we go. So have a great weekend. I don't know what you guys have got planned, but I am having a very, very chill weekend. So from one retail investor to another, this is Trader 72. See you soon, guys. See you next week for another video. Take care. Bye-bye.